TSMC just crushed earnings. Revenue hit a record. Profit jumped more than 77%. Margins expanded. AI demand still looks strong. So why did AI chip stocks keep falling? That is the real question. The market is not saying AI demand is fake. It is asking whether even great earnings are enough when expectations are already this high. This is not just a TSMC story. It is an Nvidia story, an AMD story, a Broadcom story, and a test for the whole AI semiconductor chain. This video is for education only. It is not financial advice. Let's break it down in simple English. Here is my view. Real demand can still become an overvalued trade. TSMC confirmed that the AI chip boom is producing real revenue, real profit, and real capacity investment. But confirmation is not the same as upside. When a sector is priced for rapid growth, the question is not whether revenue is growing. The question is whether revenue, margins, and guidance are improving faster than the market already expected. That is why great earnings can still lead to weak stock reactions. The business can be right. The price can still be too demanding. TSMC is where AI chip designs become physical supply. Nvidia, AMD, Broadcom, Apple, and other major customers depend on its advanced manufacturing and packaging capacity. That makes TSMC one of the cleanest tests of real AI chip demand. If leading-edge orders remain strong, TSMC sees them. If advanced packaging stays tight, TSMC sees it. And if customers begin delaying capacity plans, TSMC may see that before the change spreads through the rest of the supply chain. That is why one TSMC report can influence Nvidia, AMD, Broadcom, ASML, Micron, and the wider semiconductor market. The reported numbers were excellent. Second quarter revenue reached about 1.227 trillion new Taiwan dollars, or $40.2 billion US dollars. Revenue grew 36% in local currency terms and 33.7% in US dollar terms. Net income rose 77.4%. Gross margin reached 67.7%. Operating margin reached 60.3%. TSMC also gave strong third quarter revenue guidance and raised its capital spending plan. Yet TSMC shares fell after the report. Semiconductor stocks were already under pressure, with the Philadelphia Semiconductor Index roughly 19% to 20% below its late June peak around the earnings release. That tells us the sell-off was not a simple demand story. It was an expectation story. Strong results confirmed that the business remained healthy, but they did not create enough new upside to satisfy a market that had already priced in a powerful AI cycle. Now let's turn the earnings report into an investment framework. 5 data points answer 5 different questions. First, revenue. TSMC's US dollar revenue grew 33.7% year over year. Revenue answers, is demand real? The answer was yes. Customers were still buying advanced manufacturing capacity at a very high level. Second, margins. Gross margin rose to 67.7% from 58.6% 1 year earlier. Operating margin rose to 60.3% from 49.6%. Margins answer, is growth profitable? Again, the answer was yes. TSMC did not only sell more, it converted that growth into much stronger operating economics. But the next quarter guide points to some normalization, with gross margin expected between 65% and 67%, and operating margin between 56% and 58%. Third, capital spending. TSMC raised its 2026 capex plan to between $60 and $64 billion, from $52 to $56 billion. Capex answers, is management confident enough to invest ahead of demand? The higher plan signals confidence, but it also increases the amount of capital committed before future returns are guaranteed. Fourth, advanced computing demand. High-performance computing represented 66% of second quarter revenue. Advanced technologies at 7 nanometers and below represented 77% of wafer revenue. HPC is not the same as pure AI revenue, but it is the platform most closely tied to AI accelerators, data centers, and advanced computing demand. These figures answer, is AI demand reaching the physical supply chain? The answer was clearly yes. Fifth, expectations. TSMC beat forecasts, raised guidance, expanded margins, and still saw its shares fall. Expectations answer: has the market already priced in too much good news? That question is harder. When a sector is priced for rapid growth, revenue growth alone is not enough. Revenue, margins, and guidance must improve faster than investors already expected. That is why the business can deliver an excellent quarter, while the stock market still says, not good enough. So what could happen next? Bull case. Demand keeps accelerating. Third quarter results reach or exceed the high end of guidance. Margins stay near the top of the guided range. And capex is clearly backed by customer commitments. Bull trigger. Guidance and margins both surprise positively. That would support another leg of earnings growth across the AI chip supply chain. Base case. Demand remains strong, but margins normalize as new technologies and overseas capacity ramp. Capex stays high, revenue keeps growing, but semiconductor stocks remain volatile because much of the AI boom is already priced in. Base trigger. The business keeps improving, but the stock reaction becomes harder. This is my current base case. The operating trend stays positive. The easy valuation expansion becomes less reliable. Bear case. Guidance slows, margins miss expectations, customers delay orders, or capex rises faster than visible demand. Bear trigger. The market starts treating AI chips as an expectations and supply problem. That would not mean AI disappears. It would mean the market begins questioning whether capacity and valuations have moved too far ahead of future returns. For Nvidia, TSMC affects accelerator supply. For AMD and Broadcom, it affects advanced AI chip production. For ASML, TSMC capex supports equipment demand. For Micron, more AI systems can support demand for high bandwidth memory. That is why one TSMC report can move the whole AI chip chain. But TSMC can only confirm demand and supply pressure. It cannot prove that every AI chip stock is cheap. A company can be essential to AI and still be priced for too much perfection. So here's the Market Mind AI 5-question framework. Pause here. 3, 2, 1. Screenshot this. Question 1. Is revenue growth still accelerating? Revenue tells us whether demand remains strong. Question 2. Are margins holding? Margins tell us whether growth remains profitable. Question 3. Is capex backed by visible demand? Capex tells us whether management expects the cycle to continue. Question 4. Are advanced node and packaging signals still tight? Capacity tells us whether AI demand is reaching the physical supply chain. Question 5. Are expectations already too high? Valuation tells us how much good news the market has already priced in. Revenue, margins, capex, capacity, expectations. Those are the 5 things I would watch. So here is my conclusion. TSMC delivered strong evidence that AI chip demand remains real. Revenue grew, profit accelerated, margins expanded, capex moved higher, and advanced computing became an even larger part of the business. But the stock market delivered a different message. The AI boom may still be real, but the easy part of the trade may be over. The next phase is not about proving that AI demand exists. It is about proving that growth, margins, and guidance can keep beating expectations. That is the new test for AI chip stocks. If TSMC keeps delivering strong growth with disciplined margins and visible customer demand, the supply chain story remains healthy. But if guidance slows, margins weaken, or capex moves ahead of demand, valuation pressure can spread quickly. Comment. Boom if you think TSMC confirms the AI chip story. Comment. Warning if you think expectations are too high. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.